Imagine a number so vast it challenges comprehension, a figure that quietly shapes the decisions of governments, markets, and ordinary lives across the globe. The United States has accumulated a national debt that now exceeds $38 trillion, a figure that is growing faster than at almost any point in modern history. While policymakers for decades often treated the debt as a distant concern, recent trends suggest we have entered a new phase one, in which fiscal realities are beginning to dictate policy in ways that touch every part of the economy. For many years, the conversation around debt revolved around abstract ideas. We owe it to ourselves, or economic growth will absorb it over time. In practice, these reassurances allowed borrowing to continue without immediate consequences. But the scale of the current debt is not just large, it is historically unprecedented. More than half of the federal budget now goes toward interest payments. To put it in perspective, the government spends more annually to service its debt than on national defense, Medicaid, or many other essential programs combined. This dynamic creates what economists call a debt spiral. In households, debt can be managed by cutting expenses or increasing income. Governments, however, face a different reality. Large portions of federal spending are mandatory, including Social Security and Medicare, leaving little room for reduction. As a result, the government often borrows to pay interest on existing debt, adding to the principal, which then increases future interest obligations. This cycle accelerates over time, creating pressure that conventional policy tools struggle to address. Historically, nations have three ways to reduce the burden of debt: austerity, default, or inflation. Austerity, involving sharp tax increases and spending cuts, is politically challenging and economically disruptive. Default, outright refusal to pay, risks collapsing domestic and global financial systems, a scenario the U.S. cannot afford as the issuer of the global reserve currency. The remaining approach, managing the debt through inflation's more subtle but no less consequential. By keeping interest rates lower than inflation, the government effectively reduces the real value of what it owes over time. The effects of this policy are already apparent. Inflation slowly erodes the purchasing power of currency, while assets like stocks, real estate, and other investments often rise in value due to increased liquidity. This dynamic transfers wealth toward those who own these assets, often before price increases filter through to broader consumers. In essence, the system redistributes value indirectly, favoring those with early access to newly created money in financial markets. In this environment, the Federal Reserve is no longer operating in isolation. Fiscal policy and monetary policy are increasingly intertwined. The central bank's actions are constrained by the government's debt obligations, a phenomenon known as fiscal dominance, where once the Fed could raise interest rates aggressively to control inflation, doing so today would increase debt servicing costs to unsustainable levels. As a result, monetary policy is partly dictated by the needs of the Treasury, and the independence of the central bank is increasingly limited by fiscal realities. This shift represents more than just a technical financial adjustment. It marks a transformation in the relationship between government, money, and citizens. The mechanisms through which wealth is created, transferred, and eroded are now deeply influenced by the sheer scale of government debt and the methods employed to manage it. Over time, this has profound implications for economic inequality, individual savings, and the behavior of markets. While debt might seem like an abstract concept, it has tangible effects on the lives of millions of Americans, shaping wages, housing, and the ability to build financial security. Newly created money does not enter the economy evenly. When the Federal Reserve or government injects liquidity, it primarily enters financial institutions and large investors first. These participants can deploy capital into stocks, real estate, and other assets ahead of the general population. By the time this money circulates more broadly through wages or government spending, prices have often already risen. This phenomenon, historically observed in economic theory, explains why asset owners often benefit disproportionately during periods of monetary expansion, while wage earners see slower growth in real purchasing power. The metrics used to gauge economic conditions also shape these outcomes. Inflation, as measured by official statistics, determines cost of living adjustments for Social Security and other government programs. However, the methodology of these calculations has evolved over decades, subtly influencing the official representation of consumer prices. Adjustments, including substitutions for goods and quality improvements, can lower reported inflation compared with the real-world experiences of households. The result is that the erosion of purchasing power is partially hidden, while the government maintains fiscal balance and bondholders are repaid in nominal terms. Another critical tool in managing the debt is what could be described as structural market influence. Large financial institutions, often constrained by regulations, are required to hold government bonds as part of liquidity requirements. This creates a consistent demand for U.S. debt, even when interest rates offered are low. By effectively ensuring a stable market for government securities, these policies reduce borrowing costs but also shape the flow of capital throughout the financial system. Through these mechanisms, the federal government orchestrates a slow and steady transfer of wealth from broad-based savers to institutions, investors, and the state itself. While it is neither secret nor illegal, the implications are profound. Ordinary citizens often bear the indirect cost of managing national debt through inflation and lower real returns on savings, while those with early access to capital capture most of the benefits of financial expansion. The historical precedent for this approach is clear. After World War II, the United States carried a debt-to-GDP ratio exceeding 100%. Rather than raising taxes sharply or defaulting, the government relied on negative real interest rates, combined with sustained inflation, to reduce the burden of debt over time. Bonds were repaid, but the real value of those repayments was smaller than the amount originally borrowed. This process, repeated under modern conditions, continues today, using advanced tools and regulatory structures designed to stabilize markets while managing obligations. As governments pursue these policies, the financial environment for individuals is fundamentally altered, requiring new approaches to preserve wealth and navigate risk. Traditional saving strategies, once considered prudent, are increasingly ineffective in a world of sustained inflation and low interest rates. Cash holdings in government bonds, historically safe options, now lose purchasing power over time. For citizens seeking to protect their wealth, owning tangible or scarce assets, real estate, equity in productive enterprises, commodities, or certain digital assets becomes a central strategy. These assets often outperform cash in periods of controlled inflation and monetary expansion, preserving value relative to the broader economy. The next stage of this evolution may involve digital currency. Central bank digital currencies, CBDCs, are being explored by governments worldwide, offering unprecedented control over monetary policy and financial transactions. Unlike cash, digital currencies could allow central banks to implement policies such as variable interest rates on balances, conditional spending requirements, or limits on holdings. While still under development, these tools highlight the growing integration of fiscal policy and monetary oversight, and the increasing capacity of governments to manage liquidity and demand within the economy. Ultimately, the current trajectory reflects a slow but deliberate adjustment in how wealth, debt, and policy intersect. By reducing the real value of debt over time, while maintaining nominal obligations, governments can continue to fund commitments without overt default. For individuals and institutions, understanding these dynamics is essential for long-term financial planning. Preserving purchasing power increasingly depends on strategic allocation of resources, awareness of inflationary effects, and participation in asset markets. History offers lessons in both caution and strategy. Nations that have faced similar pressures often relied on a combination of monetary expansion, market management, and structural reforms to stabilize debt burdens. The United States today is navigating comparable challenges with unique tools and constraints shaped by its global role and economic scale. Observing the interplay between fiscal policy, monetary policy, and asset flows offers insight into the subtle, ongoing transformations shaping the financial landscape.